All right, welcome everyone to this explainer. I am super excited to dive into this today because we are unpacking one of the absolute wildest, most brutal market case studies I've seen in a while. We're going to trace the unbelievable roller coaster of a token called Block Street, or BSB. But listen, this isn't just a story about one crazy asset. By picking apart the anatomy of this specific trade, we are going to uncover a much deeper structural lesson about how markets actually work. We're pulling back the curtain to reveal exactly why the average retail trader is, quite frankly, walking straight into a trap.
Okay, let's jump right in. Check out this number, plus 43%. That is the kind of single-day pump that gets literally every trader's attention, right? On April 27, 2026, Block Street just went parabolic. The price blew past 82 cents and ended up tapping an intraday high of almost 94 cents. I mean, while the rest of the altcoin market was just kind of chopping around doing nothing, BSB was acting like a rocket ship on overdrive, just completely obliterating millions of dollars in short positions along the way.
But, well, gravity is undefeated. Just days later, reality hit hard. By April 30th, the price had completely collapsed by over 46%, crashing all the way back down to the 44-cent level. And this wasn't just some gentle, healthy pullback. Oh no, this was a brutal technical rejection, followed by just an absolute avalanche of selling pressure. Millions of dollars in capital wiped out again, but this time on the way down.
So, to understand how all that capital was actually extracted, we're going to break this down into 5 parts. 1. The Block Street roller coaster. 2. Unpacking the fundamentals. 3. Anatomy of a short squeeze. 4. The hidden token trap. And 5. Why retail traders lose.
Starting off with Part 1, the Block Street roller coaster.
Let's look at the exact timeline here, because it's fascinating. The token had its initial launch, the token generation event, back in early March. And then it just hung out in a consolidation phase. Then out of nowhere, on April 27th, boom, we get that massive, leverage-driven 43% peak, pushing it almost to $1. And then practically in the blink of an eye, straight into a 46% dump by April 30th. It is literally a textbook boom and bust cycle, but compressed into just a few days.
Which brings us to Part 2, unpacking the fundamentals. Okay, so before we get into the crazy price manipulation, we need to understand what this token actually is. Block Street isn't just some random meme coin. It was built on a hugely popular narrative right now, real-world assets. The whole pitch was connecting DeFi with traditional finance, mainly using 2 protocols. First, you have Aqua, which is a liquidity routing engine to minimize slippage. And second, there's Everst, a decentralized lending layer letting you use tokenized equities as collateral. So on paper, it sounds amazing. It sounds like institutional-grade infrastructure. And that incredibly strong narrative is exactly the bait that got retail traders so invested.
All right, Part 3, anatomy of a short squeeze.
So what actually caused that massive 43% spike? Well, if we look at the data, it definitely wasn't organic demand from people who just suddenly believed in the tech. Actually, scratch that. It was almost entirely orchestrated. Look at the digital footprints left right before the explosion. Arkham Intelligence flagged some wild movements. A Bybit hot wallet moved nearly 4 million BSB. BitGet took in 2 separate 1 million BSB deposits within just 11 hours. And at the exact same time, open interest, the total amount of open derivative contracts, exploded from $10 million to over $73 million in less than a month. Smart money and whale wallets were quietly loading up and positioning themselves on exchanges right before springing the trap.
And when that huge amount of pre-positioned capital finally forced the price up, it triggered an absolute bloodbath. In just 24 hours, $3.24 million in short positions got liquidated, compared to only $1.83 million in longs. Think about what happens when a short gets liquidated. The exchange literally forces that trader to buy the asset back at market price to cover their loss. So all that forced buying acts like pure rocket fuel, just violently accelerating the price upward.
And as the price is just ripping higher, the crowd naturally rushes in, trying to chase the pump. It got so crazy that at the peaks, Binance funding rates hit an unbelievable 79.1%. In derivatives, a funding rate that heavily positive means the longs, the people betting it'll keep going up, are paying a massive, completely unsustainable premium just for the privilege of keeping their trades open. It's the ultimate sign of a dangerously crowded trade where literally everyone is rushing to one side of the boat.
Let's move to Part 4, the hidden token trap.
You know, a squeeze fueled by leverage and forced liquidations, it mathematically cannot last forever. And the real catalyst for the crash was buried deep in the project's tokenomics. Just look at this contrast.
Out of a billion token total supply, only 20.77% was actually circulating. A whopping 79.23% was locked up or vesting. When the circulating supply is that tiny, it takes barely any money to pump the price. But the flip side? It means there's a gigantic mountain of tokens just waiting to unlock and completely flood the market with sell pressure.
And here is where the panic truly set in. Arkham Intelligence exposed a huge centralization risk. A single proxy wallet held over 75% of the entire BSB supply. We're talking hundreds of millions of dollars controlled by one entity. So, when the project team suddenly transferred a huge chunk of tokens, the market immediately assumed the worst. A massive dump was incoming. That psychological panic, crashing into an already exhausted short squeeze, was devastating. Traders absolutely scrambled for the exits, and the price nosedived back to 30 cents just as fast as it had gone up.
Finally, Part 5. Why Retail Traders Lose.
Okay, so we've seen the nuts and bolts of the Blockstreet pump and dump, but let's pull back and look at the macro lesson here. Because Blockstreet is the absolute perfect example of why retail traders consistently get crushed. Major regulatory bodies actually force exchanges to report their failure rates, and they show that between 70 and 89% of retail clients lose money trading leverage products. Think about that. That failure rate is just staggering. But why? Are people just bad at trading? Well, no. The truth is, the system is structurally rigged against them. Even if you have the perfect strategy, you're constantly fighting transaction friction. Spreads, fees, and slippage are always slowly bleeding your account dry. But the bigger issue is human psychology. Retail traders naturally fall into emotional position sizing. You win a trade, you feel invincible, so you crank up the leverage. Or worse, you average down and throw more money into a losing trade. And then there's asymmetric holding times. Our brains are literally wired to panic sell our winners way too early to lock in a tiny profit, while stubbornly holding on to massive losers, just praying they bounce back. But here's the real kicker. You aren't just fighting your own brain. You are fighting the house. Crypto exchanges actively make a fortune off this volatility through liquidation fees and spread manipulation. A lot of these platforms use internal liquidity engines that can literally see exactly where everyone's stop losses are, and they engineer these sudden, violent price wicks just to hunt those stops and extract your capital. On top of that, the user interfaces are meticulously designed. I'm talking flashy profit dashboards, virtual confetti, the whole shebang, just to trigger dopamine hits and keep you hooked in this endless addiction loop.
So what does this all mean for us? It all comes down to this quote right here. When you see something like Blockstreet absolutely rip 43% and then completely crash, you really have to ask yourself, are you actually playing an information game, outsmarting people to find the best asset, or are you just blindly participating in a process game, one that is structurally designed from the hidden tokenomics all the way down to the flashy exchange buttons to slowly bleed you dry? Understanding the difference between those two games is the absolute first step to actually protecting your money. So think about that the next time you see a chart go completely vertical. Are you the player or are you being played? Thanks for joining me on this explainer today, and stay safe out there.